Welcome back to my channel where we make finance easy to understand. Today we are diving into something you have probably heard of before but may not fully understand. Exchange traded funds or ETFs. We will explore what an ETF is, how it works, and most importantly, how it's different from mutual funds. By the end of this video, you will have a solid understanding of ETFs, their benefits, and whether they are right investment for you. So grab a coffee, sit back, and let's jump in. Introduction to ETFs. Let's start with the basics. What is an ETF? ETF stands for Exchange Traded Fund. Think of an ETF like basket that holds various securities like stocks, bonds, or commodities. When you invest in an ETF, you are essentially buying a slice of that entire basket. This allows you to invest in multiple assets without having to buy each one individually. One way to understand ETFs is to think of them like a mutual fund. But there are a few twists, we'll get back to you soon. ETFs have become extremely popular over the past 2 decades because they offer a unique blend of flexibility, diversification, and generally lower cost. In fact, as of 2023, ETFs manage around $9 trillion in assets worldwide. That's a lot of people trusting ETFs as a part of their investment portfolio. Features of ETFs. Alright, now that we know what an ETF is, let's dive into its key features. Trading on stock exchange. ETFs are bought and sold on stock exchange like stocks. This means you can buy or sell an ETF at any time during the trading day. Unlike mutual funds, which are only priced once at the end of each day, ETFs have live prices throughout the day. Diversification. ETFs allow investors to diversify their portfolio easily. For instance, if you buy an ETF that tracks S&P 500 index, you are gaining exposure to 500 of largest US companies. Lower fees. ETFs generally have lower expenses ratios than mutual funds. Expenses ratios are the annual fees that fund managers charge for managing the fund. ETFs are typically passively managed, which means they try to mirror the performance of a specific index, like S&P 500, rather than trying to outperform it. This passive management style keeps costs down. Transparency. Most ETFs disclose their holdings on a daily basis. This allows investors to see exactly what assets the ETFs hold and helps you make informed decisions. Tax efficiency. ETFs are considered to be more tax efficient compared to mutual funds. This efficiency comes from how ETFs are structured, but we'll get into that little bit later in this video. Just know that ETFs tend to have fewer taxable events. Types of ETFs. Now that we covered the basic features, let's talk about the different types of ETFs. Stock ETFs. These ETFs invest in a portfolio of stocks and aim to replicate the performance of a specific stock index, like S&P 500 or Nasdaq 100. Bond ETFs. Bond ETFs give investors access to the bond market. Whether it's government bonds, corporate bonds, or municipal bonds, there are ETFs available for various types of bonds. Sector and industry ETFs. These ETFs focus on specific sectors or industries like technology, healthcare, or energy. So if you are particularly interested in the tech sector, for example, you could invest in a technology focused ETF. Commodity ETFs. If you are looking to invest in raw materials like gold, silver, or oil, commodity ETFs are the ways to go. They track the prices of these commodities, giving you exposure to them without having a physical own them. International ETFs. Want exposure to international markets? International ETFs allow you to invest in foreign companies and emerging markets without the complexities of directly trading on foreign exchanges. How ETFs work? So, how exactly do ETFs work? When you buy an ETF, you are purchasing shares in fund that holds a specific collection of assets. The goal of most ETFs is to mimic the performance of a specific index or an asset class, rather than trying to beat it. This is why ETFs are often called passively managed funds. The ETF provider will purchase the assets in that index and divide ownership of these assets into shares, which are then sold to investors. This is different from mutual funds, where managers actively buy and sell assets within the fund to try to outperform the market. Differences between ETFs and mutual funds. Alright, now let's go to one of the most important parts of this video. The difference between ETFs and mutual funds. While they might be seen similar at first glance, they actually have several key differences. Trading flexibility. ETFs trade on stock exchange, which means you can buy or sell them throughout the day. Mutual funds, on the other hand, you are only traded once at the end of the day after the market closes. Management style. Most ETFs are passively managed, which means they are designed to track a specific index. Mutual funds, particularly actively managed ones, have fund managers who are constantly making decisions about which assets to buy and sell, aiming to outperform the market. Cost structure. ETFs generally have lower expenses ratios compared to actively managed mutual funds. That's because ETFs don't require as much as buying and selling of securities, and they don't require a team of analysts and managers. This cost advantage is one of the reasons ETFs have gained popularity in recent years. Minimum investment requirements. Mutual funds often have a minimum investment requirements, sometimes ranging from $500 to $3,000 or more. ETFs, however, do not have minimum beyond the price of one share, making them accessible for smaller investors. Tax efficiency. ETFs are usually more tax efficient due to the way they are structured. When you sell shares of mutual fund, the fund might need to sell assets, triggering capital gains that are passed on shareholders. With ETFs, shares are bought and sold on exchange, so they don't have the same tax impact. Transparency. Most ETFs disclose their holdings daily, whereas mutual funds only disclose their holdings on a quarterly basis. This makes ETFs a better choice if you want to know where exactly your money is at all times. Dividend reinvestment. Mutual funds often automatically reinvest dividends, but with ETFs, it's typically up to the investor to reinvest dividends if they wish. Pros and cons of ETFs. So, should you consider investing in ETFs? Let's go over the pros and cons. Pros of ETFs. Lower cost. ETFs tend to have lower fees, cost effective for long-term investors. Flexibility. You can buy and sell ETFs anytime during the trading hours. Diversification. They provide broad exposure to different asset classes, sectors or countries. Tax efficiency. ETFs are generally more tax efficient than mutual funds. Transparency. You can see the holdings daily. Cons of ETFs. Trading cost. If you trade ETFs frequently, transaction fees can add up. Potential for lower returns. Since many ETFs are passively managed, they might not provide the same returns as actively managed funds in certain market conditions. Less personalized management. In an ETF, there is no active management adjusting the portfolio to capitalize on market opportunities. How to choose between ETFs and mutual funds? Now, you might be wondering how to choose between ETF and mutual fund. Here are a few things to consider. If you prefer flexibility and want to trade during the market hours, ETFs might be better suited for you. If you are seeking lower fees and tax efficiency, ETFs generally have an edge. If you are looking for professional management and believe in the potential of active management to outperform the market, you might lean towards the mutual funds. Consider your financial goals, risk tolerance, and investment strategy before making a decision. Also, remember that you don't have to choose one or the other. You can have both ETFs and mutual funds in your portfolio. Conclusion. To wrap it all up, ETFs and mutual funds are both powerful tools for investors, each with its own advantages and disadvantages. ETFs are popular for their flexibility, lower cost. Remember, both ETFs and mutual funds can be valuable additions to your investment portfolio, and it doesn't have to be either or choice. They're just different tools that can help you achieve financial growth depending on your goals, risk tolerance, and strategy. Investing is personal, so make sure you choose what aligns best with your plans. Thanks for watching, and if you found this video helpful, please hit the like button and subscribe for more financial insights. Drop a comment below if you have questions or topics you would like us to cover next. And don't forget to share this video with anyone who is curious about ETFs or mutual fund. Until next time, happy investing.